This podcast is brought to you by Empor.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice. CME Group, the story of how Chicago built the world's financial risk machine.
Picture this. It's 4 a.m. in Chicago, and while the city sleeps, a vast electronic network hums to life. In microseconds, billions of dollars change hands through futures contracts on everything from corn to cryptocurrencies, interest rates to weather patterns. This is CME Group at work, the invisible infrastructure that allows the world to hedge against an uncertain future. The company occupies a gleaming tower at 20 South Wacker Drive, but its roots trace back to 1898 when it was nothing more than the Chicago Butter and Egg Board. Today, CME Group operates the world's leading and most diverse derivatives marketplace, processing over 20 million contracts daily across 150 countries. It's a business that prints money by enabling others to manage risk, a beautiful paradox where volatility and uncertainty translate directly into revenue. Here's the question that should fascinate any student of business history. How did a regional exchange for dairy products evolve into the central nervous system of global finance? How did Chicago, not New York, not London, become the epicenter of financial innovation? And perhaps most intriguingly, how did a handful of traders and visionaries build what is arguably the most powerful financial monopoly you've never heard of? This is a story about standardization creating trillion-dollar markets, about immigrants revolutionizing global finance, about technology disrupting century-old traditions, and about how the boring business of clearing trades became one of the most profitable enterprises in modern capitalism. It's also a story about power, who has it, how they got it, and what they do with it when entire economies depend on your infrastructure. We'll journey from the muddy streets of 1840s Chicago to today's high-frequency trading wars, from shouting traders in colorful jackets to algorithms executing millions of trades per second. Along the way, we'll meet larger-than-life characters like Melamed, who escaped the Holocaust to reinvent global finance, and explore moments of crisis like the 2010 flash crash that nearly broke the markets. Most importantly, we'll decode the business model that generates 90% plus operating margins, understand the regulatory moats that protect this empire, and examine whether cryptocurrency and decentralized finance represent an existential threat or just another market to dominate. Because understanding CME Group isn't just about understanding one company. It's about understanding how modern capitalism manages risk and who profits from that essential service.
The story begins not with CME, but with grain elevators along the Chicago River in 1848. That year, 82 merchants gathered above a flour store to establish the Chicago Board of Trade, CBOT, creating what would become the world's oldest futures exchange. They had a problem that seems quaint today, but was existential then. Farmers would flood Chicago with grain after harvest, causing prices to collapse. Then supplies would dwindle in winter, sending prices soaring. The solution they invented, standardized to-arrive contracts for future delivery, would revolutionize not just agriculture, but the entire concept of risk management. These weren't the complex derivatives we know today. A to-arrive contract was elegantly simple. I agree to deliver 5,000 bushels of wheat to you in 3 months at today's price. Both parties win. The farmer locks in a price before planting. The miller secures supply before he needs it. What made Chicago special wasn't the concept, but the standardization. CBOT created uniform contracts with specific grades, quantities, and delivery dates. Suddenly, these contracts could be traded like any other commodity. You didn't need to take delivery of the wheat. You could sell your contract to someone who did. By the 1890s, Chicago had become America's undisputed commodities hub, with railroads from every direction converging at the city's massive stockyards and grain elevators. But there was a gap in the market. While CBOT dominated grains, no exchange focused on perishable commodities, until 1898 when a group of butter and egg dealers founded what would become CME. The Chicago, Butter and Egg Board was founded in 1898 as an agricultural commodities exchange, emerging from members of the Chicago Produce Exchange who saw opportunity in the growing trade of perishable dairy products. The timing was perfect. Refrigerated rail cars had just made it possible to ship butter and eggs long distances, creating a national market that needed price discovery and risk management tools. The early board operated from a modest trading floor where dealers shouted bids and offers for butter and eggs, the only two contracts initially traded. Surplus butter was salted and stored in basements for future sale, a primitive form of inventory management that would evolve into sophisticated warehousing and delivery systems. What seems mundane today, tracking egg prices, was revolutionary then. The board created standard grades for eggs, fresh, storage, checks, dirties, and butter, extras, firsts, seconds, allowing these products to be traded as fungible commodities rather than individual lots. The board's most important innovation was introducing time contracts in the 1880s, agreements to deliver butter or eggs at a future date. These weren't yet the standardized futures we know today, but they planted the seed. Time contracts were only a small part of the board's activity, and early attempts to implement margin rules were controversial, as traders resisted putting up collateral for their positions. World War I changed everything. The war's disruption of global food supplies made agricultural markets wildly volatile, and the little butter and egg board found itself at the center of national food security debates. Speculators flooded in, trading volumes exploded, and the board's leaders realized they needed to professionalize or perish. In 1919, the board was restructured and renamed Chicago Mercantile Exchange, reflecting a new focus on commodities beyond butter and eggs, including potatoes, onions, and cheese. This transformation from the Chicago Butter and Egg Board to the Chicago Mercantile Exchange wasn't just a rebranding. It was a declaration of ambition. The new CME would compete directly with the mighty Chicago Board of Trade, expanding beyond dairy into all manner of agricultural products. The stage was set for what would become one of the great business transformations of the 20th century, though few could have imagined that this agricultural exchange would one day trade Bitcoin futures and weather derivatives.
The escape began in Bialystok, Poland, where 7-year-old Leibel Melemdowicz lived with his parents in 1939. Following Germany's invasion of Poland and with the outbreak of World War II, his family fled to Lithuania to avoid capture by the Nazis. His mother would later tell him she didn't let go of his hand for 2 years, a detail that captures both the terror and determination of their journey. The family's survival hinged on one of history's great acts of moral courage. In 1940, the Japanese consul general to Lithuania, Chiune Sugihara, issued his family a life-saving transit visa, and they made the long trek across Siberia. Sugihara had defied direct orders from Tokyo 3 times, ultimately choosing humanity over career, issuing thousands of visas that allowed Jews to escape through Japan. The Odyssey took 2 years, spanned 3 continents, 6 languages, the Trans-Siberian Railroad, and Japan, happily ending in the United States in 1941. Chicago became home for the Melameds, where young Leo embraced American culture with the fervor of a convert. He excelled in school, earned an undergraduate degree from the University of Illinois in 1952, and a law degree from John Marshall Law School in 1955. But fate had other plans than a conventional legal career. While in law school, he was looking for a law clerk job and answered a want ad from a firm looking for a runner, thinking the firm Merrill Lynch, Pierce, Fenner, and Bean, with that many names, could be nothing but an established law firm. Instead, he worked as a runner in the produce futures markets of the Chicago Mercantile Exchange while in law school and learned about the business. As he would later describe it, I was Alice stepping through the looking glass into a world of not just one Mad Hatter, but hundreds. The trading floor captivated him. The shouting, the hand signals, the controlled chaos of price discovery. He practiced law until 1965 and was elected to the CME board in 1967. Melamed became chairman of the Chicago Mercantile Exchange in 1969. At 37, he was young, ambitious, and possessed of an immigrant's understanding that America rewards those who reimagine the possible. The moment arrived in 1971. In July 1971, President Nixon closed the gold window and effectively ended the fixed exchange rate regime. The Bretton Woods system, which had governed international monetary relations since 1944 by pegging currencies to the dollar and the dollar to gold at $35 per ounce, collapsed overnight. It sent markets into turmoil, unleashing economic and political reverberations. Melamed saw opportunity where others saw chaos. With currencies now floating freely, businesses worldwide faced unprecedented foreign exchange risk. But there was a problem. The interbank market was limited to banks acting for themselves or their global institutional clients. An individual, regardless of his standing, purpose, or wealth, or businesses that did not measure up to the international commercial standards demanded by the banks, were barred from participation. To validate his vision, Melamed made a brilliant strategic move. Melamed was quite young when he came up with the idea for trading futures on currencies, and he was concerned that he would not be able to secure the board of directors' approval. He commissioned Milton Friedman, the future Nobel laureate from the University of Chicago, to write a paper supporting currency futures. Milton Friedman charged the CME group about $7,500 for the study. Given that FX trading is worth hundreds of millions, if not more to the CME, it was one of the greatest trades ever made. Armed with Friedman's intellectual firepower, Melamed pushed forward. In 1972, under his leadership, the CME created the International Monetary Market, IMM, the world's first financial futures exchange, and launched currency futures. On May 16, 1972, the Chicago Mercantile Exchange's International Monetary Market Division, IMM, launched 7 currency futures contracts: British pounds, Canadian dollars, Deutsche Marks, French francs, Japanese yen, Mexican pesos, and Swiss francs. The launch was met with profound skepticism. The New York financial establishment mocked Chicago's audacity. Currency trading belonged to banks, they insisted, not to a bunch of pork-belly traders. But Melamed understood something fundamental. Democratizing access to financial markets creates liquidity, and liquidity creates value. The timing was perfect. With the abandonment of Bretton Woods, the likelihood of more volatility in the currency markets was all but assured, and there would be other consequences as well. Corporations needed to hedge. Speculators wanted to trade. The IMM provided the infrastructure for both. 20 years after their inception, Nobel laureate in economics, Merton Miller, named financial futures the most significant innovation of the past 2 decades. What started as currency futures soon expanded to interest rate futures, stock index futures, and beyond. Melamed hadn't just created a new product. He had invented an entirely new asset class. The agricultural exchange that once traded butter and eggs had become the birthplace of modern financial engineering.
The trading floor at CME in the mid-1980s was controlled chaos incarnate. Hundreds of traders in brightly colored jackets, each color denoting a different firm, screamed bids and offers while using elaborate hand signals to communicate across the din. It was called open outcry, a system that had remained essentially unchanged since the 1800s. Fortunes were made and lost in split seconds based on a trader's ability to catch someone's eye or shout louder than the next guy. Leo Melamed looked at this scene and saw obsolescence waiting to happen. The rest of the world was computerizing. Why not futures trading? In 1987, Melamed spearheaded the creation and introduction of Globex, the world's first electronic trading system, and became its founding chairman. The concept was revolutionary and heretical in equal measure. Trading without humans, without the pit? It was like suggesting the Vatican go digital, an affront to centuries of tradition and, more importantly, to the livelihoods of thousands of floor traders who controlled the exchange. The resistance was fierce and personal. Floor traders weren't just defending their jobs, they were defending their entire identity. These were men, and they were almost all men, who had spent decades perfecting the art of pit trading. Reading body language, sensing market momentum through the crowd's energy, using physical positioning to gain advantage. They had paid hundreds of thousands of dollars for their trading seats. Electronic trading threatened to make all of that worthless. The politics of getting Globex approved were Byzantine. Melamed had to navigate between floor traders who saw it as an existential threat, board members who worried about cannibalizing existing business, and technology partners who weren't sure if the concept was even feasible. The solution was classic Melamed. Position Globex not as a replacement for pit trading, but as a complement, a way to extend trading hours globally when the Chicago pits were closed. When CME Globex was first launched, it used Reuters technology and network. The platform was implemented and went live on June 25, 1992, using technology and infrastructure belonging to the news service Reuters. CME Globex started off with one treasury note and a few currency products, a deliberately modest beginning designed not to spook the floor traders. The system was also the first international electronic trading system to allow off-hours trading in exchange contracts. And because of this, the system was known early on as a pre-post-market trading system. This framing was crucial. It wasn't replacing the pits, it was just filling in the gaps when traders were sleeping. But everyone knew the truth. This fully electronic trading system allows market participants to trade from booths at the exchange or while sitting in a home or office thousands of miles away. Geography would no longer matter. Physical presence would become optional. The democratization of futures trading had begun. September 1998 saw the launch of the second generation of CME Globex using a modified version of the NSC trading system. By 2002, the average daily volume of contracts at CME Globex exceeded 1 million for the first time. In 2004, the CME Globex volume, for the first time ever, surpassed the physical pit volume, a watershed moment that signaled the beginning of the end for open outcry trading. On October 19, 2004, the 1 billionth transaction was recorded. What started as an after-hours experiment had become the backbone of global derivatives trading. By 2012, electronic trading on CME Globex constituted 84% of the total volume of the CME Group's various markets. Today, more than 90% of total volume at the exchange occurs electronically on CME Globex. The success of Globex wasn't just about technology. It was about timing and network effects. Once liquidity started building on the platform, it became self-reinforcing. More traders meant tighter spreads, which attracted more traders, which improved liquidity further. It was the same dynamic that had built Chicago's commodity pits a century earlier, but now playing out in silicon and fiber optic cables instead of grain elevators and railroad tracks.
The turn of the millennium marked a radical transformation for CME. For 102 years, it had operated as a not-for-profit membership organization, essentially a club owned by the traders who used it. But the success of Globex and the changing dynamics of global finance demanded a new structure. CME needed capital to invest in technology, flexibility to make strategic decisions quickly, and currency to pursue acquisitions. The answer was demutualization. In June 2000, exchange members voted overwhelmingly to transform the then not-for-profit, membership-owned organization into a for-profit, shareholder-owned corporation. The demutualization plan was approved by an affirmative weighted vote of 98.3% of the members, casting votes at a special membership meeting held on June 6, 2000. On November 13, 2000, CME became the first U.S. exchange or commodities exchange to demutualize into a joint stock corporation. The mechanics were complex and politically fraught. As a result of our conversion into a for-profit corporation in the fall of 2000, individuals and entities who, at the time, owned trading privileges on our exchange became the owners of all the outstanding equity of CME. The challenge was creating a structure that preserved member privileges while allowing for outside investment. The solution was a dual-class share structure that would become a source of controversy for decades. More than 95% of Class A common stock and 100% of Class B common stock were held by persons or entities who owned memberships on our exchange. Class A shares represented economic ownership, the right to profits and appreciation. Class B shares carried trading rights and the ability to elect certain board members. This split created an inherent tension. Economic owners wanted profit maximization, while trading members wanted to preserve their historical privileges. As a consequence, adopting a for-profit approach to business, including strategic initiatives aimed at optimizing volume, efficiency, and liquidity. The transformation was immediate and dramatic. Record trading volume of more than 411.7 million contracts in 2001, an increase of 78.1% over 2000, validated the strategy. Then came the IPO. In 2002, CME Group, the parent company of CME, became a public company via an initial public offering, going public in December 2002. The company priced 5.75 million shares at $35 each, raising about $200 million. For members who had inherited or purchased seats for a few $100,000, the windfall was extraordinary. Seats that had traded for $500,000 in the 1990s were suddenly worth millions in public equity. But the real story wasn't the immediate wealth creation. It was the strategic flexibility that being public provided. With a public currency and access to capital markets, CME could now think bigger, much bigger. The stage was set for one of the great consolidation plays in financial history. The demutualization also created lasting tensions that would haunt CME for years. The trading floor claims and fee breach claims, brought by Class B shareholders, alleged that CME Group breached their contractual obligations by eliminating their privileged access to trading platforms and imposing new fees without obtaining required member approval. These lawsuits seeking billions in damages would drag on for over a decade, a reminder that transforming a mutual organization into a public company leaves scars that never fully heal.
The boardroom at 20 South Wacker was electric with tension on October 17, 2006. CME had just announced its intention to merge with its historic rival, the Chicago Board of Trade, in an $8 billion deal. For over a century, these two exchanges had competed fiercely just blocks apart in downtown Chicago. CBOT traders looked down on CME as the minor league exchange that traded pork bellies while they traded the mighty Treasury complex. CME saw CBOT as hidebound and arrogant, slow to embrace electronic trading. Now, they would become one. The drama escalated quickly. While never a foregone conclusion, the outcome of the CME-CBOT merger was called into question on March 15, 2007, when the Intercontinental Exchange, Inc. placed an unsolicited bid for the CBOT during the FIA Boca International Futures Industry Conference, delivering the written offer by sliding it under the doors of CBOT's then President and CEO Bernard Dan, and then Chairman Charles P. Carey's hotel rooms. ICE initially offered CBOT Holdings, Class A common stock, 1.42 shares of ICE Class A common stock for each share of CBOT Holdings, Class A common stock, besting the CME offer by $1 billion. Jeff Sprecher, ICE's aggressive CEO, saw an opportunity to break up what would be a derivatives monopoly and grab CBOT's valuable agricultural and treasury contracts for his upstart electronic exchange. What followed was a 4-month bidding war that would reshape the global exchange landscape. ICE upped its offer Tuesday for the Chicago Board of Trade, hoping the lure of $2.5 billion in cash will overcome the Chicago Mercantile Exchange's competing merger bid. The battle wasn't just about price. It was about the future of derivatives trading. Would it remain centered in Chicago, or would ICE's Atlanta-based, fully electronic model prevail? CME fought back with strategic arguments. CME and CBOT have achieved more than $1 billion in margin efficiencies through our clearing agreement. Efficiencies that would be lost if CBOT clearing transfers to ICE. A CME-CBOT combination allows customers to trade complementary products on a single platform and is expected to save customers at least $70 million in annual operating expenses. The turning point came when the Justice Department announced it had no antitrust concerns about a merger involving the CBOT and the Merc on June 11, 2007. ICE had argued that regulatory issues would block the deal, but the DOJ disagreed. Still, the battle continued until the final days. shareholders approved a merger with Chicago Board of Trade in an $8 billion deal on July 9, 2007, and the deal closing on July 12, 2007, creating the world's largest financial market with the overarching holding company launching as CME Group. Ultimately, the CBOT stockholders received $11.3 billion for the exchange, $4 billion more than CME's initial offer. But this was just the beginning. CME Group acquired New York Mercantile Exchange, NYMEX, and COMEX for $8.9 billion in cash and CME Group stock in August 2008. This brought energy and metals, oil, natural gas, gold, silver, under the CME umbrella. The timing was fortuitous. The 2008 financial crisis was about to make commodities trading extraordinarily volatile and profitable. CME Group acquired the Kansas City Board of Trade for $126 million in cash in December 2012, securing control of hard red winter wheat futures. Then came the crown jewel. CME Group acquired the London-based Nex Group for $5.5 billion in November 2018, gaining BrokerTec's treasury trading platform and expanding CME's reach into European markets. Each acquisition followed the same playbook: identify exchanges with complementary products, leverage CME's superior technology and clearing capabilities to extract synergies, use the monopoly position to maintain pricing power. By 2018, CME Group had assembled an empire that controlled the vast majority of U.S. futures trading and significant chunks of global derivatives markets. The Dow Jones deal deserves special mention. CME Group agreed to purchase 90% of Dow Jones and Company's financial indexes business, including the Dow Jones Industrial Average. CME Group and Dow Jones and Company subsequently contributed the Dow Jones indexes to the formation of S&P Dow Jones Indices joint venture, with CME Group receiving a 24.4% ownership interest. In April 2013, CME Group purchased the remaining Dow Jones and Company interest for $80.0 million, increasing CME Group's interest in S&P Dow Jones Indices from 24.4% to 27.0%. This wasn't just about trading. It was about controlling the entire ecosystem. Own the indexes that derivatives are based on. Own the exchanges where they trade. Own the clearinghouses that guarantee them. Own the data that prices them. It's vertical integration on a scale that would make Rockefeller jealous.
At 2:32 p.m. Eastern on May 6, 2010, the unthinkable happened. The May 6, 2010 flash crash, also known as the crash of 245 or simply the flash crash, was a United States trillion-dollar flash crash, which started at 2:32 p.m. EDT and lasted for approximately 36 minutes. In those terrifying minutes, the Dow Jones Industrial Average plunged 998.5 points, about 9%, most within minutes, only to recover a large part of the loss. Temporarily, $1 trillion in market value disappeared. At the center of the maelstrom was CME's E-mini S&P 500 futures contract, the most liquid equity index derivative in the world. What started as turbulence in the futures market cascaded through interconnected trading systems, creating a feedback loop that nearly broke modern finance. The initial reports blamed everything from fat finger errors to Greek debt concerns. But the truth was more disturbing. In April 2015, Navinder Singh Sarao, an autistic London-based point-and-click trader, was arrested for his alleged role in the flash crash. According to criminal charges brought by the United States Department of Justice, Sarao allegedly used an automated program to generate large sell orders, pushing down prices, which he then canceled to buy at the lower market prices. The CFTC alleged that on May 6, 2010, the day of the so-called flash crash, Sarao was active in the E-mini S&P futures market on the CME. He used the layering technique continuously from 11:17 a.m. to 1:40 p.m. on May 6, 2010, as well as the spoofing technique between 12:33 p.m. and 1:45 p.m., creating downward pressure on prices in the market. These orders represented approximately $170 million to over $200 million, worth of persistent downward pressure on the E-mini S&P price and represented 20 to 29% of the entire sell side of the order book. What made this particularly embarrassing for CME was that they had noticed the suspicious behavior before. More than a year before the May 6, 2010 flash crash, CME Group noticed questionable trading in its E-mini market by a particular electronic trader who was placing orders and canceling them. CME saw the suspicious activity again on the day of the crash and warned the trader that day that orders must be placed in good faith, without an intent to cancel. The trader responded 2 weeks later, "Kiss my ass." However, CME Group, a large futures exchange, stated that insofar as stock index futures traded on CME Group were concerned, its investigation found no evidence for this, or that high-frequency trading played a role, and in fact concluded that automated trading had contributed to market stability during the period of the crash. Following the flash crash on May 6, 2010, together with other regulators, CME did a thorough analysis of all activity in its markets during the flash crash and concluded, along with regulators, that the flash crash was not caused by the futures market. The flash crash exposed uncomfortable truths about modern market structure. A single trader operating from his parents' house in London could allegedly manipulate the world's most important financial market. The speed of electronic trading meant that disruptions could cascade globally in milliseconds, and the complexity of interconnected markets meant that nobody, not regulators, not exchanges, not even the biggest banks, fully understood how the system could fail. The event led to modern-day implementation of coordinated cross-market circuit breakers, as CME's Globex platform halted trading in an automated response while the New York Stock Exchange did not. This lack of coordination exacerbated the chaos as different markets operated under different rules during the crisis. For CME, the flash crash was both vindication and warning. Their technology had worked. Globex didn't fail, clearing continued. Markets eventually recovered. But it also highlighted their systemic importance. CME wasn't just a business anymore, it was critical infrastructure. The question, too big to fail, wasn't hypothetical. If CME's systems failed, global markets would freeze. This reality would shape every strategic decision going forward, from technology investments to regulatory relationships.
The announcement came on December 1st, 2017, at the height of Bitcoin mania. CME would launch Bitcoin futures on December 18th, 2017, becoming the first major regulated exchange to offer cryptocurrency derivatives. The decision was controversial internally. Many board members worried about reputational risk, regulatory backlash, and the operational challenges of settling a digital asset. But CEO Terry Duffy saw opportunity where others saw danger. The launch of futures trading on Bitcoin by the Chicago Board of Options Exchange, CBOE, on December 10th, 2017, and the Chicago Mercantile Exchange, CME, on December 18, 2017 is a milestone development in the cryptocurrency market. While CBOE beat CME to market by a week, CME's superior technology and liquidity would ultimately win. CBOE discontinued offering new Bitcoin futures on March 14, 2019, leaving CME as the dominant regulated crypto derivatives venue. The timing seemed perfect. Bitcoin was approaching $20,000. Crypto was mainstream news. Institutional interest was building. Then the bubble burst. Futures trading activity, however, remained dull through 2018, courtesy of the crypto bear market. Critics mocked CME for launching at the peak, suggesting they had legitimized a bubble. But CME played the long game. May 2019 was the best month for derivatives giant CME's Bitcoin futures volume since its 2017 launch, as nearly 300,000 contracts were traded in the 31-day period. Average daily volume reached more than 13,600 contracts, equal to $515 million notional value, or 68,000 equivalent Bitcoin. The impressive growth of CME Bitcoin futures increased its notional value, validating the strategy. Meanwhile, the pandemic accelerated structural changes that had been building for years. CME Group announced in 2021 it will permanently close most physical trading pits, including those for grain trading, which had been closed since March 2020 due to COVID-19. The iconic trading floors that once defined Chicago finance were now museum pieces. But CME was already looking to the future. CME Group and Google Cloud announced a 10-year strategic partnership to accelerate CME Group's move to the cloud and transform how global derivatives markets operate with technology. Google has also made a $1 billion equity investment in a new series of non-voting convertible preferred stock of CME Group. The deal wasn't just about technology, it was about reimagining what an exchange could be in the cloud era. Through this long-term partnership with Google Cloud, CME Group will transform derivatives markets through technology, expanding access and creating efficiencies for all market participants. The partnership will focus on creating real-time data and analytics capabilities, with Google Cloud's data analytics and machine learning solutions helping CME Group provide clients with on-demand information and toolkits for developing models, algorithms, and real-time risk management. 2022, CME Group futures and options reached record average daily volume of 23.3 million contracts. The crypto derivatives business was booming. Competition from new entrants was being successfully repelled. The monopoly seemed unassailable. But challenges loom. Competition from crypto exchanges and DeFi threatens to disintermediate traditional futures markets. Young traders on Binance and FTX don't care about CME's century of history. They want 24/7 trading, instant settlement, and no intermediaries. The collapse of FTX in late 2022 temporarily vindicated CME's regulated approach, but the underlying threat remains. ESG derivatives and climate risk products represent both opportunity and challenge. CME has launched futures on everything from carbon credits to catastrophe bonds, but these markets remain nascent. The question is whether CME can build liquidity in these new products before competitors or entirely new market structures emerge. The battle for options market share with CBOE continues to intensify. While CME dominates futures, CBOE controls the lucrative equity options market through exclusive licenses on key indexes. Each company probes for weakness in the other's fortress, but neither has achieved a breakthrough. What's remarkable about CME's modern era is how a 125-year-old company has managed to stay at the forefront of technological change. From butter and eggs to Bitcoin, from shouting in pits to algorithms in the cloud, CME has consistently reinvented itself while maintaining its core value proposition, providing the infrastructure for price discovery and risk management. The question for the future isn't whether CME will adapt. History suggests it will. But whether the very concept of centralized exchanges will survive the decentralized revolution.
The genius of CME's business model lies in its simplicity. It's a toll booth on the highway of global finance. Operating a global derivatives marketplace allowing institutions and individuals to trade futures and options, CME doesn't take risk on trades. It simply facilitates them and clips a fee on every transaction. But this description understates the sophistication of what CME has built. CME runs multiple interconnected businesses that reinforce each other. CME Globex electronic trading platform allows customers in approximately 150 countries to trade. The company operates two cash market businesses, BrokerTech for dealer-to-dealer fixed income trading and EBS providing foreign exchange spot trading. Most crucially, CME Clearing serves as counterparty to every cleared transaction, including both listed and OTC derivatives. This vertical integration creates a fortress of competitive advantages. Consider the network effects. Liquidity begets liquidity. The more traders on a platform, the tighter the bid-ask spreads, which attracts more traders, which improves liquidity further. It's a virtuous cycle that's nearly impossible for competitors to break. A new exchange might offer lower fees, better technology, even superior products. But without liquidity, it's worthless. And CME has the liquidity. The clearing monopoly deserves special attention. When you trade a future on CME, you must clear it through CME Clearing. This isn't just a regulatory requirement. It's a massive competitive moat. Clearing is where the real money is made, with higher margins than execution. It's also where CME controls risk, holds collateral, and generates float income on billions in margin deposits. Competitors can try to steal execution business, but without clearing, they're fighting with one hand tied behind their back. Technology infrastructure provides another layer of defense. CME Globex processes millions of messages per second with latency measured in microseconds. The company has spent billions building data centers, laying fiber optic cables, and optimizing code. A startup might have better ideas, but can they match CME's reliability? When billions of dollars are at stake, traders choose boring reliability over exciting innovation. Regulatory advantages compound these moats. CME operates as a designated contract market, DCM, and derivatives clearing organization, DCO, regulated by the CFTC. These aren't just licenses. They're relationships built over decades. Regulators trust CME because CME has never failed, never missed a settlement, never lost customer funds. That trust translates into favorable treatment on new products, rule changes, and regulatory interpretations. The data business represents the evolution of CME's model. The company sells real-time quotes, historical data, and analytics to thousands of firms who need this information for valuation, risk management, and trading decisions. It's a beautiful business. Near 100% margins, subscription-based, mission-critical for customers. As markets fragment and complexity increases, the value of CME's data only grows. Pricing power dynamics reveal the strength of the franchise. CME has consistently raised fees despite customer complaints and competitive threats. Why? Because the value of access to CME's markets far exceeds the cost. A basis point increase in fees is noise compared to the liquidity, reliability, and network benefits CME provides. Customers grumble, threaten to leave, then pay up and keep trading. The fee structure itself is a masterpiece of economic design. CME charges per contract, not per dollar value, meaning fees automatically increase with inflation and market growth. There are fees for execution, fees for clearing, fees for data, fees for connectivity. Large traders get volume discounts, locking them into the platform. Retail traders pay full freight but generate minimal servicing costs. It's price discrimination at its finest. But the real brilliance is how these pieces fit together. Owning the indexes through S&P Dow Jones that underlie the derivatives that trade on your exchange using your technology, and clear through your clearinghouse while generating data you sell back to the market. It's vertical integration that would make Rockefeller weep with envy. Every piece reinforces the others, creating a business model that's both incredibly profitable and incredibly difficult to disrupt. The numbers tell the story: 90% plus market share in many products, 50% plus operating margins, 30% plus return on equity, consistent high single-digit revenue growth. This isn't just a good business. It's one of the great monopolies in modern capitalism, hiding in plain sight as a boring financial infrastructure company.
The CME story offers a masterclass in building and maintaining a platform monopoly in financial services. The first lesson is the power of standardization in creating markets. CME didn't invent futures, but they perfected the standardization that makes futures tradable. Every contract has identical terms except for price. This commoditization of complexity is what enables liquidity. The lesson for entrepreneurs: find complexity that can be standardized, then own the standard. First mover advantages in financial innovation prove more durable than in other industries. CME launched currency futures in 1972, Euro-dollar futures in 1981, E-mini-S and P futures in 1997, Bitcoin futures in 2017. In each case, being first meant capturing the liquidity pool that becomes self-reinforcing. Late entrants offer better terms, lower fees, superior technology, and fail anyway because liquidity trumps everything. The demutualization playbook that CME pioneered has been copied globally. Convert a mutual organization owned by members into a for-profit corporation owned by shareholders. The members get a windfall, management gets flexibility, and the business gets access to capital markets. But CME's dual-class structure, preserving some member rights while going public, created decades of legal battles. The lesson: clean breaks are better than compromises. Vertical integration in financial markets follows a specific pattern: trading plus clearing plus data. Execution alone is a commodity business with declining margins. Clearing is where the economics improve. Higher margins, customer lock-in, regulatory moats. Data is the crown jewel. Pure information goods with zero marginal cost and pricing power. CME built all three, but the sequencing matters. You need trading to generate clearing volume and both to create valuable data. Managing stakeholder transitions might be CME's most underappreciated skill. They've navigated from member-owned to public, from floor trading to electronic, from domestic to global, from traditional assets to crypto. Each transition alienated core constituencies: floor traders, old-school members, regulatory traditionalists. But CME managed these transitions through patience, compensation, and gradually shifting power to new stakeholders while keeping old ones just happy enough not to revolt. The platform business model in finance has unique characteristics. Unlike tech platforms that can scale infinitely at zero marginal cost, financial platforms face regulatory constraints, capital requirements, and operational risks that limit scaling. But they also enjoy regulatory moats, customer stickiness, and mission criticality that tech platforms envy. CME optimized for the reality of financial platforms: slower growth but higher margins, fewer customers but deeper relationships, boring but essential. Regulatory capture versus regulatory partnership is a delicate balance. CME doesn't capture regulators in the corrupt sense. They partner with them. The exchange helps write the rules, educates regulators on market structure, provides data for oversight. In return, regulations often embed CME's advantages. It's not corruption, it's worse. It's a system where the incumbents' expertise makes them indispensable to rulemaking. The technology adoption curve in financial markets differs from consumer tech. CME took 5 years to plan Globex, another 5 to build it, and 2 decades for electronic trading to fully replace the pits. But once adopted, the technology becomes infrastructure, impossible to replace without massive coordination. The lesson: move deliberately in financial technology. Being too early is as bad as being too late. Network effects in financial markets are more powerful than in social networks. Facebook users might switch to TikTok, but futures traders can't leave CME without sacrificing liquidity. The network effect isn't just about size. It's about the economic value locked in the network. Every participant makes others more valuable by improving price discovery and liquidity. The acquisition integration playbook CME perfected has 3 components: keep the products, migrate the technology, eliminate the overhead. When CME bought CBOT, NYMEX, and others, they maintained separate brands and products to preserve customer relationships, moved everything onto Globex for operational efficiency, then cut redundant staff and systems. It's brutal, but effective.
Bull case. CME represents one of the last great monopolies in American business. The company controls 90% plus market share in numerous futures contracts with no realistic competitive threat. Regulatory barriers make new entry nearly impossible. You can't just start a futures exchange in your garage like a tech startup. The business model features extraordinary operating leverage. Revenues grow with volume and volatility, but costs are largely fixed. Every incremental trade drops straight to the bottom line. Secular growth in derivatives markets seems inevitable. As the world becomes more interconnected and volatile, the need for risk management only increases. Climate change creates demand for weather derivatives. Cryptocurrency adoption drives crypto futures. The financialization of everything, from carbon credits to water rights, creates new markets for CME to dominate. Global uncertainties around inflation, geopolitics, and technology ensure volatility, and volatility is CME's product. The financial profile is stunning. 50% plus operating margins, 40% plus returns on equity, consistent free cash flow generation exceeding net income. The company requires minimal capital investment relative to earnings. No factories, no inventory, no physical products. It's essentially a software business with regulatory protection, generating subscription-like revenues from must-have products. Bear case, regulatory risk looms large. A progressive administration could view CME's monopoly as problematic, forcing contract fungibility or clearing interoperability that would destroy the moat. European regulators have already pushed for more competition in clearing. The CFTC could mandate lower margins or fee caps. Political sentiment has turned against financial speculation. Futures markets make convenient scapegoats for commodity inflation. Crypto disruption represents an existential threat that bulls underestimate. Decentralized exchanges running on blockchain don't need CME's infrastructure. Smart contracts can replace clearinghouses. 24/7 trading, instant settlement, and programmable derivatives make CME's model look antiquated. Young traders native to crypto might never touch traditional futures. The collapse of FTX bought time but didn't eliminate the threat. Interest rate sensitivity cuts both ways. Rising rates help CME by increasing volatility and trading volumes, but they also reduce the present value of future cash flows and make CME's rich valuation harder to justify. At 25x earnings, CME trades at a premium that assumes continued growth and margin expansion. Any disappointment could trigger multiple compression. Competition from ICE, CBOE, and international exchanges continues to intensify. ICE has successfully attacked CME's energy complex. CBOE dominates equity options and keeps probing CME's index futures. Eurex could leverage European regulatory support to grab share. Chinese exchanges are building yuan-denominated alternatives to CME products. The monopoly has cracks. Valuation considerations. At current levels around $230 per share, CME trades at approximately 25x forward earnings, 15x EBITDA, and 5% free cash flow yield. These multiples are premium to both historical averages and exchange peers. The market is pricing in continued monopoly power, successful cloud transformation, and crypto derivatives growth. Any disappointment on these fronts could lead to significant multiple compression. The quality deserves a premium. Few businesses combine CME's margins, returns, and competitive position. But the premium leaves little room for error. Revenue growth of 5 to 7% and modest margin expansion are already priced in. The stock works if CME maintains its monopoly and captures new markets. It doesn't work if competition, regulation, or disruption materializes. Investment conclusion. CME is a remarkable business trading at a full price. For long-term investors who believe in the durability of centralized financial infrastructure, it's a high-quality compounder. For those worried about disruption or valuation, it's priced for perfection in an imperfect world. The asymmetry skews negative. More downside from multiple compression than upside from operations. But betting against CME's monopoly has been a losing trade for decades.
What would happen if CME didn't exist? It's a thought experiment worth conducting. Global commerce would slow dramatically. Every international trade involves currency risk that needs hedging. Every loan involves interest rate risk. Every commodity producer and consumer faces price risk. Without centralized futures markets, these risks would be managed through bilateral negotiations. Inefficient, expensive, and unreliable. The societal value of derivatives markets is immense but invisible. Farmers can plant crops knowing they can lock in prices. Airlines can budget fuel costs years in advance. Pension funds can hedge their liabilities. The stability this creates, the ability to transfer risk from those who can't bear it to those who can, is foundational to modern capitalism. CME doesn't just facilitate speculation. It enables the real economy to function. Chicago's role in global finance seems improbable until you understand the history. New York had the stocks, but Chicago had the commodities. New York had the banks, but Chicago had the entrepreneurial spirit. New York looked down on futures as gambling, while Chicago embraced them as innovation. That cultural difference, pragmatic, innovative, slightly rebellious, made Chicago the derivatives capital of the world. Leo Melamed named among the 10 most important Chicagoans in business of the 20th century by the former editor of the Chicago Tribune. It's deserved recognition for someone who fundamentally changed how the world manages risk. But the CME story is bigger than any individual. It's about how markets evolve, how institutions adapt, and how financial innovation, for better or worse, shapes the modern economy. The future of CME likely involves continued evolution rather than revolution. The company will adapt to crypto, integrate artificial intelligence, move to the cloud, and find new assets to financialize. The core model, providing infrastructure for price discovery and risk management, will endure even as the technology and products change. CME has survived 2 world wars, countless financial crises, and multiple technological revolutions. Betting on its continued adaptation seems wise. But perhaps the most important reflection is on the nature of financial infrastructure itself. CME is plumbing. Essential, boring, immensely profitable plumbing. It's a reminder that in business, as in life, controlling the infrastructure often matters more than creating the products that flow through it. CME doesn't trade. It enables trading. It doesn't take risk. It manages risk. It doesn't create value. It captures value created by others. That might sound parasitic, but it's not. CME provides a genuine service that markets need and willingly pay for. The company's profits reflect the value of reducing friction, creating standards, and providing trust in an untrusting world. In an era obsessed with disruption and innovation, CME reminds us that sometimes the best business is the boring business that everyone needs, but no one can replicate. The Chicago Butter and Egg Board that became CME Group is one of the great business transformations in American history. From agricultural commodities to financial engineering, from shouting traders to silent algorithms, from Chicago roots to global reach. It's a story of constant evolution while maintaining core purpose. CME doesn't just reflect the financialization of the global economy, it enabled it. For better or worse, we live in the world that CME helped create. A world where everything has a price. Every risk can be hedged, and even the weather is a tradable commodity. This podcast is brought to you by Emport.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice.